Hello everybody and welcome back to the HTC channel. Today we're going to do a summary, an economical summary of what is currently happening and what could the near future look like. So currently we are looking at the National Federal Debt chart. So this chart shows the national federal debt. The term national debt refers to the outstanding financial obligations of a country. So the national debt of the United States is what the federal government owes creditors, including debt held by the public and the federal government trust funds. So basically speaking, this shows the balance of the credit card account of the USA. So as we can see, it tracks all the way from about 1960s, and in a slow pace it has been going up, and you can see here it ends. It has peaked out, it has stopped out. So currently it is at $32.3 trillion is the debt of USA. So we don't see any retractions, nothing getting better debt-wise of the United States of America. It is just shooting up. Okay, take a look at the other chart I have in front of you now. So that's effective federal funds rate, right? So the federal funds rate target rate is the target interest rate set by the Federal Open Market Committee. So this is the rate at which commercial banks lend and borrow their excess reserves to each other overnight, right? So the committee sets a federal funds target rate 8 times a year based on current economic conditions. In this chart, it's displayed the effective federal funds rate, which is calculated as the effective median interest rate of overnight federal funds transactions during the previous business day. Okay, so what do we see here? The worst was in around 1980s. It completely skyrocketed, right? Then it has been going down slightly with lower tops up until 2020. When the COVID hit us, right? So we just mumbled there a bit, and then it has shot up. It's currently about 5.3%, which is high, right? That's not looking too good, right? So one way how to combat high inflation is by raising interest rates, right? Because higher interest rates means having higher borrowing costs. People will start to spend less money. The decrease in demand for goods and services will then cause inflation to fall. The federal funds rate can also influence short-term rates on consumer loans and credit cards, as well as have large influences on the stock market. Because of the younger age of the cryptocurrency market, it is not well understood yet how it reacts to such macroeconomic changes. However, because of the relatively high degrees of correlation between cryptocurrencies and stocks, it would be wise to take these factors into account. Okay, and here we are looking at the history of inflation chart, which is year over year, right? So beginning from the 1950s all the way up to now. We can see it's been quite up and down, as it should. Currently, it is sitting here, which is about 3.23%. So from the last peak of over 8%, which was followed by the COVID crash, right? It has gone down. So that is good. So inflation is defined as the increase in prices or a measure of purchasing power of money, right? So when the inflation rate is increasing, prices go up, and fixed amounts of money have less buying power, so you can buy less than you could buy yesterday for the same amount of money. Vice versa for negative inflation rates, right? So negative would be here if it goes under the median line. So the most common way to calculate the inflation rate is by recording the prices of goods and services over the years. This is called price index. You take a base year and then keep track of the percentage rate changes of those prices over the years. The most common price index is the Consumer Price Index, or CPI. To calculate the inflation between any 2 years, you then calculate the percentage rate change of the CPI. So if we look at this in a more basic way, besides the fact that the high inflation rates influences our daily lives by giving our money less purchasing power, it also has influence on the markets, right? When inflation spikes, usually interest rates also spike to combat the inflation. So they try to level it out and sort of cancel each other out, right? So the inflation doesn't go crazy high. In the 1940s and 70s, the S&P 500 bottomed when inflation first peaked, most likely partially because of the interest rates. So asset prices in economy are used as a collateral, so government will want a small inflation percentage. For them, inflation is better than a deflation. All right, and here we are looking at the unemployment rate chart. So this chart is going crazy sideways, right? Up and down, up and down. So as we can see, first, the biggest spike ever recorded in history was quite recently. That's correct. That was when the COVID hit. The unemployment hit the all-time high. Why? Because this disaster forbid us going to work, forbid us going out, forbid people to going offices, to malls, to whatever they work. People who only work online were able to work. Everyone else was either let go or in the lead, right? So this basically shows the let go part, right? A lot of people lost their jobs, but right after it fell right back down, and you can see it is starting a small uptrend. At the moment, it's not significant, right? It's very small, but it is steady climbing up. So currently it's at 3.9%, right? So the unemployment rate represents the number of people unemployed as a percentage of the labor force, right? So anyone in the labor force older than 16 years old is defined as unemployed if they were not employed during the survey reference week, were available for work, and made at least one active effort to find a job during the 4-week survey period. That's just basically how the data is pulled to create this chart. So in order to qualify as unemployed, the person needs to currently reside in one of the 50 states of the District of Columbia, not reside in institutions, penal mental facilities, homes for aged, etc., and not to be on active duty in armed forces. So basically, standard average people who go to office, go to work, do their working day, and come home, right, and pay their taxes. So the unemployment rate tends to rise sharply during periods of economic recession. The unemployment rate also helps government agencies, financial markets, and researchers gauge the overall health of the economy. High unemployment levels have broader implications, such as more people relying on government welfare and more people having less money to spend. Well, it's obvious. You don't work, you don't have income, but you still have to pay your rent, pay your utility bills, and eat, right? So money going in, no money going in, money going out. So historically rising unemployment rates have caused the Fed to pivot, stop raising interest rates, and reconsider its tightening policy, right? So basically, change of tactics. And this final news in today's update. So the SEC had filed a lawsuit against Binance and its CEO CZ. So as you can see here, we are on X or Twitter, and CZ has stated that he is finally stepping down as CEO of Binance after he was found guilty of all the charges charged by SEC. As part of the plea deal, he has to step down from being the CEO of Binance. Binance has to pay $4.3 billion to settle all the criminal charges with the Securities Commission. Do also follow my Twitter if you want to see more feed-like news updates. You can follow this link here. The link to my profile will also be in the description. Thank you for listening and watching, and see you in the next episode.